Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Friday, February 3rd. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Is the tech rally dead or just on pause? In January, we witnessed a sharp rebound in the stock market with big tech leading the way. The Federal Reserve's recent dovish intimations have fueled the surge, especially among interest rate-sensitive growth stocks. Then, after the closing bell Thursday, a trio of bellwether tech megacaps threw cold water on investor enthusiasm. Apple, Google parent Alphabet, and Amazon all reported disappointing operating results for the end-of-year quarter that renewed worries about global economic demand and the deleterious effects of higher interest rates. Wall Street is taking a deep breath and wondering whether it got ahead of itself. Apple, the world's largest publicly traded company, missed expectations on the top and bottom lines, hurt by lower iPhone sales and production disruptions in COVID-battered China. E-commerce giant Amazon beat on revenue but missed on earnings and provided anemic guidance. The miss on Amazon Web Services sales was a particularly hard blow due to the strategic importance of cloud services for the company. Alphabet missed on earnings and revenue in large part due to a year-over-year decline of 8% in YouTube advertising revenue. Big tech surged Thursday following a strong quarterly report from Facebook owner Meta Platforms. And 2 weeks ago, Microsoft beat on earnings and provided rosy guidance. But now the tech sector euphoria is wearing off, at least temporarily. That said, I suggest that you keep your eye on the long haul. Over the next 12 months, analysts project an increase for the S&P 500 of at least 11%. Nearly 50% of S&P 500 companies have reported earnings for this earnings season, and results have been mixed, but better than expected. Among the companies that have reported, 70% have delivered positive earnings surprises in line with long-term averages. As of this video presentation, consensus expectations for fourth quarter earnings growth have improved to 0.5%, well above the previous expectation of minus 4.0% growth heading into the quarter. To be sure, we've seen a lot of layoffs so far this year in the tech sector. Those job losses cause human pain, but they're also good for the top and bottom lines. Sometimes capitalism isn't pretty. Tech companies are coming into 2023 in leaner shape. Big tech hit a speed bump with Thursday's operating results, but demand should pick up in 2023 as inflation wanes and the Fed gets less hawkish. Fed Chair Jerome Powell said at his press conference Wednesday that the disinflationary process has started. When the ordinarily dour Powell uttered those encouraging words in the late afternoon at his press conference, U.S. stocks immediately leapt higher in real time in Pavlovian response. Powell's statement provided support for the bull case, as did the Fed's rate hike of 0.25%, a widely expected step down from its previous hike of 0.50%. The federal funds rate currently hovers at 4.33%. The target rate is between 4.5 and 4.7%. The betting now on Wall Street is that the Fed will hike rates one more time in March and then pause. According to a new International Data Corporation forecast released in January, global revenue for enterprise applications will grow from about $279 billion in 2022 to $385 billion in 2026 for a 5-year compound annual growth rate of 8%. Nearly all this growth will derive from investments in public cloud software. The U.S. economy has been cooling, just as the Fed wants, but it's nonetheless forecast to grow in 2023 by 1.4%, which isn't exactly gangbusters, but neither does it constitute a recession. Importantly, especially for big tech, China's economy is forecast to grow by about 5.2% this year. Global growth is projected to reach 2.9%. It's also significant that the S&P 500 has shot past its 200-day moving average. As we pass over this speed bump, stay the course. Well, that's it for now. Thanks for watching. And if you have any questions or feedback, you can reach me at mailbag@investingdaily.com.